Hey, Doug.
Hello, Sean.
So you wanted to talk to us today about the Rehab 203K loan, which a lot of people probably outside of real estate have never even heard of.
Yep.
What's so big about the 203K Rehab loan?
That's a program offered through HUD. It's an FHA loan program. Most
Okay.
people are familiar with FHA loans, buying a regular, just a regular loan. It's just like any other loan. You just apply for it. If you qualify, you can get it and you close.
Okay.
And that's through FHA. This particular one is one where FHA's come up with a mortgage that you can buy a home that needs really substantial work done to it before you can really occupy or live in the home.
Okay. And to recap, FHA is just the government program for
It's a
loans for houses.
Yeah, it's an insurance program put out by the government, and they have their own guidelines and everything. So that's why they're called an FHA, Federal Housing Administration.
It's like instead of getting a loan from U.S. Bank, you get a loan from FHA.
Yes, it's insured by the FHA.
Right.
Right. So, and they have their own sets of guidelines. And so we do run across properties that buyers want to buy, but they need rehab. They need to be fixed up. And so there's two ways you can look at this. You can go and just go ahead and buy the property and then have funds available in your account to go ahead and pay for the repairs of the property, and then you can fix it up. The problem with that is that, number one, you might not have that much cash to be able to complete the project, depending on the status or the condition of the property or the home. And number two is that most loan programs won't let you get a mortgage on a house unless you're going to live in it.
Right.
So let's say the furnace is out. Let's say the roof needs repairs. Let's say the windows are broken or whatever. They're going to say, fine, you're qualified to buy this house at that price, but before you do, you have to get all these repairs done.
Right.
So now we're in a kind of a catch-22. I got to buy the house to do the repairs, but I can't get the loan to buy the house until the repairs are done. And so how does that all work? So that's why 203K came up. So what happens? It's first off, it's not the best loan in the world, but it is an alternative if you can't come up with like cash in the bank to be able to buy the house and fix it up and then mortgage it later.
Okay.
So what it is, the reason it's not the best loan in the world is because it's a government insured loan, and I just said the magic word government, and so there's like 10 times as much paperwork involved in this loan than there is on a regular loan. Maybe 20 times as much paperwork.
So why would people even bother?
Why would you want to bother?
Yeah.
Well, because you're getting a very good price on the property, and you know that if you fix it up, it's going to be well worth it and more. So you might want to put up with all the guidelines and all the paperwork required. So if you're okay with all that, then that's how this goes.
Okay. What do you mean extra paperwork? Like what
Well,
kinda...
for example, a lot of people that want to purchase a property that needs some rehab want to do the work themselves. This program doesn't allow that. You have to have a contractor do all the work. You can't. For example, I had a gentleman that wanted to do this, and he was a certified licensed plumber. He was also certified licensed heating contractor. They would not let him do that work,
Right.
even though he was certified. He had to get an outside contractor to submit a bid, and that outside contractor was the person who got paid when the job was done.
Okay.
So if you're thinking you're going to be a handyman type person here and get paid yourself for doing the work, that ain't going to work.
Okay.
All right. So,
but if you know a lot of people...
well, for example, here's part of the paperwork. He had to fill out a handwritten letter, or it could have been typewritten, explaining why he felt he was qualified to hang the curtains and the curtain rods and the drapes and the shades, the blind, the fixtures onto the windows. Why he thought he was qualified to be able to do that.
Okay.
And that was one page, and then that had to go in and be approved by somebody in the program to put their stamp of approval. That's okay to let them do that. So
Okay.
that's how picky they are.
Right. They're picky.
They're picky. And some of the other guidelines are, let me just see if I missed anything. Time. We're talking about lots of paperwork. Paperwork equals time. Normal loans close 30 to 60 days. 203K program, 4 months probably before you can buy the property once you start the process.
Right.
Okay, and that means start the process. That means you have identified the property and you've got an accepted purchase agreement. That's the start of the mortgage process. Okay.
Okay.
So there we go. So that you got to make sure the
And
seller.
hopefully you've been pre-approved kind of beforehand.
Yeah, you would want to make sure that your financial situation is such. But now we're talking about the time frame just to get all the paperwork done.
Okay.
And typically sellers don't want to wait that long, but and especially if it's a foreclosure or something, a regular bank that's got the house on the market, they're not going to want to wait to close for 120 days from the time. They usually say 30 days. You got to close in 30 days. So this program won't be effective or very effective for that type of property.
Okay.
All bids, of course, must be from a licensed contractor and not yourself.
Okay.
And they've got to be, the businesses have to certify that they're a legitimate business, and they might even be investigated by the FHA to make sure you're not
Setting up dummy companies.
and trying to do it yourself anyway. And the property will be appraised as is in the fix-up condition. So here we go. Normally you get an appraisal on a property right away after you get when you're in for the loan. Hey, I bought a house, I want to get a loan now. They send out an appraiser. They won't send out the appraiser until you get all the bids in. All the bids are certified, and then they'll send out the appraiser to do not an as-is appraisal, but an appraisal with the repairs done.
Yeah.
So now we've waited maybe 90 days to have this done, and the appraiser goes out, and what do you do if they don't agree? What if they say, well, no, the property won't be worth, let's say you bought it for 100 and when you're done it's going to be worth 140. You put that much in, let's say the appraiser says it's only worth 130. Now you're short $10,000, and you waited 90 days to hear this answer.
Okay.
So I'm maybe being a little negative here, but it is a program that can work. But you need to know all the ins and outs of this program, and you've got to get the renovation. Once you buy the property, once everything's approved, let's say you waited 120 days, now everything's approved. Now you buy the property. Now you've got to start work within 30 days, and it's all got to be completed in 6 months.
Okay.
That's the guidelines. And the checks, again, they hold money back at closing to pay for the improvements. The checks can't be written out to you. That's not correct. They are made out to you and the contractor. So you both have to sign off on the check for the contractor to get his money.
Okay.
And there is sometimes a delay in when the contractor says, I'm done. Let's say the contractor went and put a new furnace. Hey, here's the bill, the new furnace is in. It might take 10 days to get the money to the contractor. So the contractor has to know that there's delays on him getting the money.
Do they do inspections on that
Yeah,
stuff?
they'll do inspections also.
So they want to come in and make sure the furnace was installed correctly.
Yep. Well, not only that you did install for a furnace.
At all. They don't want any scammers. They don't want, the federal government doesn't want to look like they're getting scammed on
Right. And then if you overestimated the cost of the project, and which is nice, I mean, let's say you thought it was going to cost $30,000 and only came in at $25,000, that extra $5,000 left over in the escrow account at the very end of the project, when you're all done, that doesn't go to you.
Okay.
Well, indirectly it does. It goes to pay off the principal balance of your loan. So they apply it to the principal.
You can't use it to go buy a new TV.
No. You can't go to the Bahamas on that money.
But probably it's not going to be that much off because you've already gotten...
Yeah. Now, there is a program through the regular FHA. They will allow certain repairs to be escrowed at the time of closing, and then you can use that money to do the repairs. But normally, the house has to be in good a shape so that you can theoretically live in it. So in other words, you have to have plumbing, toilets have to flush, you have to have heat, and stuff like that. But they will let you do other repairs to the property, and but you have to have money in escrow to be able to do that. So that would mean, again, out of your pocket, unless you can convince the seller to pay for those repairs.
So Doug, back to what you were talking about with the 203K and what properties would qualify that you could actually purchase. You said like bank-owned houses probably wouldn't qualify because the bank isn't going to sit around and wait for 4 months for you to get everything figured out. So what kind of properties would be the ideal type of properties?
Well, for example, one good one is FHA's own properties. FHA has a bunch of properties they've taken back through foreclosure, and they can't sell them because they're so beat up.
Right.
So this program fits really good for that type of house.
Okay.
There's we call a HUD home. And there's not that many out there, but you can find a HUD home, and if it needs substantial work, this might be the way to do it. And if HUD isn't willing to wait the 120 days according to their own guideline programs, that's a problem. So most of the time, HUD will let you.
Okay.
That will accept your offer contingent on you getting the 203K program. So, and there might be other regular sellers out there. Let's say an estate, somebody died, they hadn't done any repairs to the property for years, and it needs substantial fixing up, roads, gutters, sidewalks, driveways, whatever.
And there's some stuff to be careful with on estate sales, as we know, getting and trying to buy an estate-owned property, who has the will been figured out, who is in control of the estate. Has all that paperwork been taken care of, with the deed and
that might be a perfect property, because if it's going to take you 120 days to get
it might take them 120 days.
It might take them 120 days to get their title cleared up.
Okay,
so you'd both be working, over the months.
You and I had that with a property bought on contract for deed by a grandson. Yeah. And it actually hadn't been cleared up properly, so you got to go through the lawyers.
Yeah.
Okay.
Yeah, I had to go through the... Okay, and let's see, there is a maximum, I believe, and I'm sorry, I can't tell you what it is, but it comes to mind that the maximum amount that they'll let you fix on the property is around $35,000. That might have been raised a little bit, but if you think the property's going to need, I got to raise the house off the foundation to put a new basement in or something, and all this is going to add up to $50,000, it ain't going to work. Okay. That's too much money. Okay. So there you go. It is a way though to get a good deal. The couple that I've done, the people are of course they got all the bids themselves, and with licensed contractors, as we explained, and they're really happy with the house now that it's all fixed up. And nobody else wanted to buy these things because they were pits. I mean, they were just like, ugh.
Right. And not like there's not like a ton of people sitting around with $30,000 in cash to fix up a property.
Right. And
that they're going to reside in.
Yeah. Right. So the only people that are usually in that position are like investors, and we call them flippers. They're going to buy a property. They've got the money in the bank. They're going to buy it. They're going to fix it up, and they're going to plan on reselling it. Right. And that's not really what I'm talking about. I'm talking about on this program, by the way, you've got to claim that you're going to live in the house. Right. You're going to be the homeowner. You're not going to flip it. So this program is not for investors. It's just for homeowners.
Okay. Well, good. Hey, thanks, Doug.
Okay. Good luck.
Bye.